At the very start of 2025, an announcement from the White House sent shockwaves through Canada, igniting a nationwide frenzy. The reason? A jaw-dropping declaration from President Donald Trump. His administration planned to impose a hefty 25% tariff on Canadian imports. It was a move that blindsided officials and businesses alike, setting off a firestorm of debates and concerns. The official justification? Border security issues, illegal immigration, and drug smuggling threats. But many questioned whether this was the full story. The news spread at lightning speed, dominating headlines and sparking instant outrage across Canada. From government offices to bustling marketplaces, from boardrooms to coffee shops, the reaction was the same: disbelief, anger, and a single burning question: how should Canada respond? Officials scrambled for answers. Business leaders calculated potential losses, and everyday citizens worried about the impact on jobs and prices. Some voices called for immediate and aggressive retaliation, arguing that Canada couldn't afford to sit back while its largest trading partner turned up the heat. "We have to hit back," they insisted. "If we don't, what's next?" Others urged caution, warning that a trade war could spiral out of control, potentially doing more harm than good, especially to Canadian workers and businesses that relied heavily on exports to the US. But one thing was certain: Canada was not going to stand idly by and take the hit without a fight. Prime Minister Justin Trudeau made his stance crystal clear. Canada will not take this sitting down, he declared with determination, calling for national unity in the face of economic aggression. "Everything is on the table," he warned, a statement that left no doubt Canada was prepared to respond decisively. Ontario Premier Doug Ford took things even further, suggesting that Canada should strike where it hurts. He floated the idea of banning American liquor imports and even cutting off energy exports to key U.S. states like Michigan and New York. "If they want to play hardball, we have options too," Ford insisted. But this is where things start to get complicated. The economies of the U.S. and Canada are deeply intertwined, so much so that pulling one thread could unravel the entire fabric. A significant portion of American refineries, particularly in the Midwest and Rocky Mountains, rely heavily on Canadian heavy crude. If Canada were to squeeze its oil supply, gas prices across the U.S. could soar overnight. And back home, Canada's oil-rich provinces could face serious economic fallout of their own. Yet, the energy drama wasn't just unfolding in North America. Across the Pacific, China was making bold moves in its own oil trade. U.S. crude exports to China had taken a sharp nosedive, plummeting from 115.6 million barrels in the previous year to just 81.9 million barrels. The reason? A cocktail of economic shifts: China's slowing growth, its push for renewable energy, and a growing preference for oil from alternative sources like Russia and Iran. And Beijing wasn't simply stepping away, it was hitting back. In direct response to U.S. tariffs, China unleashed its own countermeasures, slapping American energy products with fresh penalties. Starting February 10, 2025, U.S. crude oil would be hit with a 10% tariff, while liquefied natural gas, LNG, and coal would be taxed even higher at 15%. This wasn't just a minor trade dispute, it marked a massive turning point in global energy politics. Once the second-largest buyer of U.S. oil, China had now plummeted to sixth place. And this wasn't just a small shift, it was a seismic realignment that could reshape the global oil market for years to come. For decades, China had been the world's top oil importer, sucking in millions of barrels daily to power its vast economy. But new reports showed an unexpected trend. China's overall crude imports had actually dropped by 7.2% compared to the previous year. What was driving this change? A mix of factors: lingering economic effects from COVID-19, already well-stocked domestic reserves, and an ambitious push to upgrade and modernize its refineries. But here's the twist. Despite importing less oil overall, China was reshaping its buying strategy to gain more control and secure better deals. Instead of relying on traditional Western suppliers, Beijing had started leaning more heavily toward alternative sources, especially politically isolated nations like Russia, Iran, and Venezuela. The numbers told the story. According to energy tracking firms like CLR, China's imports from these sanctioned countries were on the rise. A seemingly small 2% increase in Iranian shipments, for example, might not sound like much, but when a nation is importing over 10 million barrels a day, even minor percentage changes translate to enormous shifts in the oil supply chain. So, why was China making this move? Simple: money and strategy. Ever since Russia was slapped with Western sanctions, it had been forced to sell its oil at deep discounts. China, always looking for a bargain, took full advantage, snatching up Russian Ural crude at prices well below market value. Iran, too, found a way to bypass U.S. sanctions and keep its oil flowing to China. But how? Not in the usual way. Instead of shipping oil directly, Iranian tankers often switched off their tracking systems, transferred crude to other ships at sea, particularly near Malaysia, and then continued their journey under a different name. By the time the oil reached China, it was relabeled as coming from a different country, sometimes even Malaysia itself. These covert maneuvers, strategic alliances, and retaliatory tariffs weren't just headlines, they were signs of a major transformation in global trade. With the U.S. tightening economic pressure, Canada weighing its options, and China shifting its alliances, the world was heading into uncharted waters. One thing was clear: this was more than just a trade dispute. It was a high-stakes game of economic chess, and the next moves could change the balance of power for years to come. At times, China's secretive oil supply chain extends even further, to places like Oman and Venezuela. Despite being under heavy U.S. sanctions for years, Venezuela has mastered the art of bypassing restrictions, ensuring its oil still makes its way into China. How? Through a web of complex payment systems, third-party traders, and middlemen who specialize in dodging global tracking efforts. It's an oil smuggling operation on an international scale, and China is more than willing to play along. Why? Simple economics. Venezuelan crude is often significantly cheaper than oil from mainstream suppliers like Saudi Arabia or the U.S., making it an attractive option, especially for China's smaller, independent refineries. These refineries, often outside direct government control, are hungry for cheap oil and don't have to worry about the political consequences of buying from a sanctioned country. As long as the oil keeps flowing, they'll gladly take it. But China's strategy isn't just about getting the lowest price. This is a long-term game, a play for energy security and dominance. By diversifying its oil sources and spreading its purchases across multiple suppliers, including ones that operate outside the influence of the US and Europe, China is insulating itself from Western pressure. If tensions with Washington escalate, if Western-controlled markets try to cut off supply, it won't matter. China will have backup options in place. And there's another huge bonus: profit. By securing oil at rock-bottom prices, Chinese refiners can operate with significantly higher profit margins. That gives them the freedom to sell fuel at lower prices domestically, strengthening China's internal economy. Or, even more strategically, they can flood the international market with cheap refined products, especially in Asia, further tightening China's grip on the region's energy supply. Now, here's the thing: tracking these shadowy oil trades isn't easy. But that doesn't mean experts aren't trying. Analysts have developed sophisticated methods to unravel the mystery, using a combination of satellite imagery, ship tracking data, and port records. Companies like CLR and Vortexa have become masters at following oil tankers in real time, exposing the loopholes these countries use to bypass sanctions. And trust me, the tricks these tankers pull are straight out of a spy movie. Some ships go dark, disappearing from radar by turning off their tracking systems, a tactic known as going dark. Others use a more sophisticated method, conducting ship-to-ship oil transfers in the middle of the ocean. This makes it nearly impossible to track where the oil actually originated. Hotspots like Malaysia and Oman have become key locations for these transactions, allowing crude from Iran and Venezuela to be rebranded before being shipped to China. So, even if Chinese customs records don't officially show these barrels coming from sanctioned nations, the numbers tell a different story. The surge in shipments perfectly aligns with Iran and Venezuela's production increases, meaning China is deliberately tapping into these cheaper, restricted sources, saving billions of dollars in the process and rewiring global oil flows. But China's appetite for bargain oil isn't just reshaping its own economy, it's sending shockwaves through the entire global energy market. Traditional oil powerhouses like Saudi Arabia, Angola, and Brazil are suddenly feeling the pressure. These nations, once dominant suppliers to China, are now scrambling to stay competitive. Some have even been forced to adjust their official price structures, offering discounts just to keep up. This new reality has pushed major oil producers into a tough position. With China securing deeply discounted crude from Russia, Iran, and Venezuela, Western efforts to limit these oil flows are being put to the test. The big question now? Can the West actually control the global oil market anymore? For Russia, China's shifting oil priorities have been both a challenge and an opportunity. After facing wave after wave of sanctions following its invasion of Ukraine, Russia had no choice but to pivot eastward, and China became its most crucial buyer. This move wasn't just about survival, it was a complete energy strategy overhaul. To secure China's business, Russia started offering its crude at huge discounts, undercutting many of its competitors. The result? Russia quickly shot up the ranks to become one of China's top suppliers. In 2023 alone, trade between the two nations exploded past $240 billion, and oil and gas made up a massive chunk of that figure. But Russia didn't stop there. In 2024, China completed the Power of Siberia pipeline, giving it a direct and uninterrupted flow of Russian natural gas. And now, discussions are already underway to expand those supplies with the proposed Power of Siberia 2 pipeline, a massive project that would redirect gas originally meant for Europe straight into China. This seismic shift has fundamentally altered global energy flows. Russia, once heavily reliant on European markets, is now becoming increasingly dependent on China to absorb its exports. And for Beijing, locking in long-term energy supplies from Russia gives China a huge strategic advantage, further reducing its reliance on Western-controlled markets. But nowhere is China's strategic energy playbook more evident than in its dealings with Iran. Despite crippling U.S. sanctions aimed at cutting off Tehran's oil revenue, China has remained a steady buyer, quietly purchasing Iranian crude at rock-bottom prices. And these deals aren't just about cheap fuel, they come with far-reaching political and financial implications. By continuing to buy Iranian oil, China is essentially keeping Iran's economy afloat, allowing Tehran to fund critical government programs. This isn't just business, it's geopolitics. As the global energy landscape continues to shift, one thing is clear: China is playing the long game. By securing cheap, politically isolated oil, it's not just saving money, it's strengthening its global position. The question now? How will the West respond? Because one thing is certain, the balance of power in the oil market is changing fast.